This is the first part of the presentation on financial and credit analysis. Material that we're going to be going through this week comes from a book by David Kohl and Vernon Pierce called Weighing the Variables, a guide to ag credit management. This is a very good resource with regard to credit management, credit analysis. Unfortunately, the book is out of print, and so therefore I'm going to be providing some of the chapters out of the book to you via Blackboard. But this is the first of a couple of presentations with regard to credit analysis. One of the things that David Kohl does in the book is that he puts together what he calls a time saver worksheet. In other words, these are 15 key financial data from financial statements that we have been going through. And it comes back to the recommended ratios in terms of how we're analyzing credit and analyzing financial performance back to the Farm Financial Standards Task Force. This is an example of the time saver worksheet. As you can see, there's items that come from the balance sheet, from the income statement, and then from cash flow and other statements. In this particular example here, there's three columns, and you can look at what is the 2 years ago, last year, and then the projected numbers. So it gives you the ability to look at past performance as well as what you're projecting your performance to be. And these particular items, as you can put them into the worksheet, then these items can be used to calculate the various types of measurement that we have. Now, worksheet number 1 illustrates the repayment analysis, the earnings chart. It requires 5 key financial data: net farm income from operations, gross non-farm earnings, family living expenses and income taxes, term debt principal and interest payments, and depreciation expense. The worksheet calculates a term debt repayment margin, which is line 8, and the term debt and capital lease coverage ratio. As you can see from this example of the repayment analysis, you simply just start at the top and start filling in the blanks. Net income from operation, we add back then gross non-farm earnings, which would be available to meet debt. We get a subtotal there. Then we add back depreciation and the interest paid on term debt. Depreciation has been taken out as a non-cash expense, and then we also add back the interest on term debt. Now, there's one little difference here between what I think it needs to be in there and what the worksheet has that Kohl has put together. He puts in there depreciation expense and interest paid. That will work. However, if we follow the definition of the term debt and capital lease coverage ratio, we would add back not total interest, but term debt interest. Once we have that subtotal, this gives us the earnings that are available to meet family living, income taxes, interest and principal payments, and new investments. We have to take out any family living expenses and income taxes because that's going to be a cash flow out of the operation. That then gives us the capacity to pay interest on term debt, the principal payments, and any new investments. Then we take current interest and principal payments on our term debt, which is line 6. So if line 5 gives us the capacity, in other words, this is what we have available in order to meet those current term debt principal and interest payments. And so if we take line 5, which is our capacity, and line 6, if we subtract those, we get line 8, which is the earnings available for capital replacement and term debt repayment margin. In other words, is in this particular example, if we look at the projected side, we have 229,000 available. We need 120,000. This is going to give us 109,000 margin. In other words, over and above what we needed in order to meet our term debt payments. In line 7, where we take line 5 and divide it by line 6, we get the term debt and capital lease coverage ratio. In this particular example, that's 191% or $1.91. In other words, $1.91 is available for every dollar that we need to have in terms of those term debt and interest payments. Now, the next thing we want to do is look at a sensitivity analysis. Worksheet number 2 gives us a method to perform a sensitivity analysis with regard to repayment capacity. If we take the term debt repayment margin, which is line 8, it represents the dollar amount of excess capacity that we have in order to meet our term debt and principal and interest. And so if we take worksheet number 2 and we look at this, we have 3 calculations that we want to make. One is related to a change in farm revenue, another one in terms of farm expenses, and the other one in terms of interest rate. Kohl refers to this as the 553 sensitivity rule. In other words, you set a margin or a percentage that you would like to be able to meet in terms of the sensitivity of these 3 measures. 553 says, okay, we want to try to have 5% additional margin with regard to revenue, 5% additional margin with regard to expenses, and 3% additional margin related to interest rates. So if we take the margin, which is line 8 on our worksheet number 1, and divide that by the total farm revenue, in this particular instance, this is off the projected side of worksheet 1, we get a 16% margin. In other words, if we had a 16% shortfall in revenue from what we had projected, we would still be able to meet our term debt requirements. When we look at expenses, we're looking here at the margin of $109,000. Total farm expenses is $526,800. We have a 21% margin there over and above what we needed to meet our term debt. In other words, if farm expenses were 21% greater than what we projected, we would still be able to meet our term debt payments. And then the third calculation is related to interest rates. In other words, the margin of $109,000, and then we take the sum of our operating, our intermediate term, and our long-term loans and divide that. So in other words, we had 14, if the interest rates went up by 14%, then we would still be able to meet our term debt payments. And so this gives us the ability to really measure the sensitivity of these 3 things that can happen. It doesn't take into account you can see a combination of these where revenues increased and or decreased and farm expenses increased. But this gives us some idea of what the sensitivity of these projections are. And so in terms of whether we're able to meet our term debt payments. In this example, we had revenue that could be a shortfall of 16%, and the business would still be able to meet its term debt. Expenses be greater by 21%, and interest rates by 14%. The 553 sensitivity is just a standard to measure against. For some loans, the lender might want to increase the standard. In other words, you could also say, well, we want a 10-10-6, depending on what risk level you felt like you had within that particular loan. Worksheet number 3 calculates the measures for liquidity and solvency. We've been through these before. We know how to do that, but the worksheet just brings those ratios together to where you can look at the current ratio, the working capital, and our solvency measures over the 3 years. So the 2 past years and then 1 projected year. So you can look at a trend analysis. How well is that particular operation doing with regard to their financials? One of the things that you can point out here is that over time there, the projected current ratio is going down to just about a 1-to-1 ratio, a considerable drop in working capital. But if you go back and read the chapter that these are in, what they're looking at here is an expansion in the operation. So in other words, this operation is projected to be expanding within the next year. So there's probably going to be a use of working capital in order to fund part of that expansion. And so what you see is an increase in debt. The debt to our debt to asset ratio is going up some. Equity to asset is going down a little bit, and we've seen some increase there in our debt to equity ratio. Even though if you look at this, the debt to equity ratio is still not out of line with what we might be able to expect. But what we are seeing here is that with this expansion, we're beginning to see an increase in debt, but we're also seeing that we're using our working capital in order to do that.